Happy Friday, everybody. This is your market update for February 3rd. I first want to apologize for the length of my update video yesterday. It was long, but it was cram-packed full of information, and really there was no way for me to do it any quicker. But if you didn't get a chance to watch it, I do recommend going back and checking it out. It was full of a lot of useful information. With that being said, we'll jump into today. The employment report that I mentioned yesterday that was coming out this morning at 8:30. Market was anticipating job creation of 185,000 new positions. The actual report blew that number out of the water, and the number reflected in the report was 517,000 new positions. As you can imagine, the market did not react to that favorably because the market would be concerned that the labor market is not cooling, and the Federal Reserve would have ammunition to continue hiking the Fed funds rate at a more aggressive pace. The market doesn't like that. Stock markets initially opened down, have rallied back a bit. The Dow's up about 103 points. NASDAQ and S&P 500 down slightly on the day. Mortgage-backed securities definitely did not like the news. They opened initially down 39 basis points. At one point in time, they were down over 60 basis points, but are back off their worst levels of the day, currently down about 46 basis points. It's important to note, too, that in addition to the job creation figures being a good bit higher than what was anticipated, the unemployment rate was forecasted to go up about 0.1%. In fact, it dropped to 3.4%, which was 0.1% less than what it was. And that's the lowest unemployment rate since 1969. So again, markets reading the headlines, they're running with it, and that kind of fuels some concerns about the Fed's actions moving forward. When the Fed had recently appeared to be kind of trending in a less aggressive, stance moving forward. Now, again, markets concerned about a more aggressive stance moving forward. It is important to note that the employment report that came out this morning, when you dig into it deeper, it is definitely not as stellar as what it seems. A lot of the jobs that were created are part-time jobs. And when you adjust for things like seasonal hiring, benchmarks, population figures, things like that, when you take into account those adjustments, the job creation is not near as strong as what the market would appear that it would be, and what basically the forecast would look like. So I think once the market digests that information, digs into it a little bit more, we will see a potential reversal. As of right now, with the market today, the mortgage-backed security market, we've gained a lot of what we've lost in the last 2 days. Interest rates are a little bit worse than where they were a couple days ago. All that being said, if you look at where rates have been trending for the last 9, 10, 11 weeks, certainly a whole lot better than what they were back in October, November. We'll take it. And I do think that there's room for some additional improvement moving forward as well, although at a gradual pace. So I appreciate you guys. Thanks so much. I hope you find this information useful. We'll continue to keep you updated. I hope you have a great weekend, and I'll see you on Monday.